It's oftentimes as investors, we want to see the highest revenue growth possible. Looking at this annual chart here, you can see that over the last 5 years, this company's revenue's compounded growth rate is 95%, going from 16 million to 32, 87, 297, 406 to 464. You can see that in just a 5 or 6 year span, it's went from 16 million in revenue up to almost half of a billion. It's a company that's skyrocketing in price. But what you don't see is the flip side, the bad part of this company. The free cash flow, the actual profits that this company's generating, are pretty much as bad as it gets. In the same way that we were talking about this company growing its revenue, its profits are growing in a negative way just as fast. $28 million in losses, 33 million in losses, 60 million in losses, 72 in losses. We have $99 million in losses, and then last year's $437 million in losses. And when you compare the revenue last year at 464 million, the losses were 437. The losses are almost the same as the revenue. They're having profit margins at about negative 100%, which you can see pulling up the ratios here and looking at the profit margin, it's about as bad as you'll find. It gets absolutely awful when you see this company's operations. But Beyond Meat is one that investors have loved. It's seen long-term revenue growth, had great metrics when we look at this old annual report. And at this time, this is when I was interested in this company, and analysts were projecting growth. They were still projecting 6% growth for the year, 17% growth next year, and we're going to talk about in this video why that's not going to happen. Investors are starting to get upset. It's down to another 10% today, down from its $13 share price, and hopping over to M1 Finance and pulling up the research tab, if we type in ticker symbol BYND, and we look at the last 5 years, you can see that it's down 71%. This company's all-time high was actually around $250 a share, and today it trades at 13. So that is well over a 90% downturn from its all-time high. And we're going to talk about what went wrong, why this company deserves to go down, and even though it's down 93% in the last 2 years and 87% in the last 1 year, this could go even further. I know, it's shocking to think that, but it could go even lower. We're going to talk about why that is in this video and what we got planned and what I think Beyond Meat stock has its problems with. If you haven't seen me before, my name is Jordan. I'm a millennial investor. This is my portfolio balance at the first of the month every single month since starting YouTube all the way back in April of 2020, and we update this every single month. And this is my current portfolio holdings represented in this pie here with Salesforce, Amazon, Crocs, and Google. And then of course here's my monthly YouTube income right here if you're interested, and then my lifetime YouTube income since starting the channel. Now I also show my portfolio balance every single video, which right now is 36,500. And then lastly, we also show my performance since joining this brokerage compared to the S&P, Dow, NASDAQ, and Russell 2000. We also have my portfolios that are shared. We share the growth portfolio, which are the 4 that I just said, and then we also share the dividend growth portfolio, which has 20 defensive dividend growth companies, and we're going to talk about all of these companies over the course of this year, and you can check out many of the videos I've made, which have already gone over these, but if you want to check it out yourself, you can go to M1 Finance, or you can go down below in the description and get signed up and help support the channel and get 10 free dollars while doing so, like the 129 people have done so far. So thank you for tuning in. I appreciate you watching. Without further ado, let's go ahead and get into Beyond Meat. Now, this company had been producing pretty good revenue growth, like we said, over the last 5 years. It's just pretty much been going vertical and to the right. It is going straight up. Now, the thing is, if we look at the quarterly numbers, you can tell once we get to about 2020, once we get to about this level, that's when things start to get shaky. This revenue growth was looking beautiful for a long time until 2020. And now, as of the most recent quarter, this company, for pretty much the first time ever, is starting to put up negative numbers. A year ago, in this most recent quarter, they did 149 million, and then today they produced 147. Negative growth of 1.6%. Now, this is the type of company, if you're wanting to own a stock like Beyond Meat, the reason why this company's share price went so high on its IPO was that massive growth rate. You can see that the stock just went to a ridiculous valuation, just insane levels of market cap. And that is why when you look at this annual report, this is from 2020 when this came out, and when I was considering investing in this company myself, yeah, that's right, I was considering investing deep into this company myself because I was looking at numbers like this, the revenue growth going insanely high, and I was thinking that this company was going to scale very quickly to billions of dollars in revenue. Well, based on this most recent report, this is not going to happen. And the reason why I say this is because of this article that we're about to read right now. Now, what I'm going to tell you is that first off, before I tell you the performance and what they're planning on doing, I want to tell you about what they're planning on doing with management, and you can decide whether or not that you think that this is fair. It says the following: Jonathan Nelson, Senior Vice President of Manufacturing Operations, who was put in place to oversee operational activities on an interim basis, is now in that role on a permanent basis, said the filing. His base salary will rise $355,000 effective October 13th, so now, and he will have a bonus target of 40% of that salary, along with the restricted stock unit award of $250,000. Whether you like it or not, do you like this company's diluting you? They're awarding shares to these big executives every single quarter, and they're giving out raises to big people that are working in the company. Now let's read further and you can decide whether or not that they deserve these type of raises and stock-based compensation, because if we read further, it says that Beyond Meat cut its third quarter and full year forecast and announced a strategic shift aimed at achieving positive cash flow operations. The company said its job cuts will account for about 19% of its workforce. It will book a $4 million one-time charge just to cover the cost, and it's now expecting third quarter revenue of $82 million, which is a 23% downturn from the year earlier period and is well below the FactSet consensus of 113. Analysts were expecting 113 million. They said, we're not going to do that. We're going to only come in with 82. And for the full year, it expects the revenue to be at around 400 to 425 million, down from the previous estimate of about 500 million, which is down from about 20% of its previous estimates. Now, they're firing employees. They're laying off its workforce, and this company is really starting to struggle to grow. A negative 1.6% revenue growth is not very good. For a growth company that's not growing, that's already bad. But now, next quarter, if you compare this to last quarter, you can see that the quarter coming up, they had 106. And then going back to the article here, they're projecting that now they're only going to put up 82. That is a 23% downturn. The one reason why you want to invest in this company is for the revenue growth. Because let's take a look at the profits, okay? Let's look at the free cash flow. Like I said, it's gotten worse each and every year. And last year, they produced negative $437 million. Now, let me give an example real quick, and let me show you a company that put up negative free cash flow. Amazon was a company that put up negative free cash flow, and they had a negative number of $14 billion. Now that sucks. That's not good for shareholders. They spend a lot of time and a lot of effort trying to build out infrastructure and hire new employees, and they temporarily put up a negative free cash flow while every single year they've been putting up massive profits to make up for that. Now $14 billion is a big number, but when Amazon is a $1.1 trillion company, it's not that big of a deal because it's such a small percentage of the company. When you look at Beyond Meat, they're not even $1 billion company. They're $900 million, and they almost lost half of its market cap in free cash flow last year. Now that's the annual. Let's look at the most recent quarter, see if it's improving. You can see that it's just pretty much going straight down. Last quarter, they produced the worst ever at almost $200 million in negative free cash flow. The most recent quarter was $90 million. And so throughout the first 2 quarters of the year, this company has already produced negative $270 million in negative free cash flow. And at that rate, they're on track to hit even worse than they did last year, despite no revenue growth. And so it's very easy to look at these analyst forecasts, what they had just the other day at 6% revenue growth, 17% revenue growth next year, and easily say that they're not going to hit these numbers. I'm not sure what the profits are going to come as. I'm not sure how bad the free cash flow is going to be. But what I can almost guarantee you is that this company is going to put up negative revenue growth, which is not what you want to see as a company. But we want to see, and what we want to invest in is long-term compounders, like the companies that I invest in. Salesforce. This is the company that consistently grows its top and bottom line every single quarter. Look at this quarter over quarter. And they have these weird reportings where they only really report free cash flow twice a year. But if you look on an annual basis, you can see that they're at record levels, positive free cash flow, billions of dollars on the balance sheet, and this is reflected on their balance sheet. You can see every single quarter the cash pile will go up after they made their big acquisition, which was right here. It's consistently gone up from $9 billion up to $13 billion. They're getting healthy and healthier financially speaking. Now, what about Beyond Meat's free cash flow, and what about their balance sheet? Now, let's look at the debt real quick. If you see their debt, they haven't really had any until about 2021. Early 2021, they took about $1 billion in debt, and it stayed flat. It hasn't really gone anywhere since then. Now, what has the cash done? Let's look at their cash piles, which if you look at their cash piles while the debt has stayed flat at a consistent $1.1 billion, what has their cash piles done? It's consistently gone lower and lower. When they made that big debt raise, they had a bunch of money, and it went down and down and down and down, and they've already burned through well over half of that big raise they did just a year and a half ago. They burned $500 million in cash, over $500 million in just a year and a half. It's really sad to see. And so when you have dilution of shareholders, the ownership you have in this company is getting smaller and smaller by the day as they dilute shareholders. The balance sheet is getting unhealthier. It's getting worse by the day as the cash pile burns. You have free cash flow, which is not going in the right direction. It's going in the wrong direction. And then the one benefit, the one major reason you had to own this company was its awesome revenue growth, is now gone. And so when I look at this, I ask the question, why are you owning this company? If you own Beyond Meat stock at $13, I still think that this company's overvalued. This begs the question, what would I buy Beyond Meat stock price? Well, the short answer is I would never buy it. But if I were to buy this company's share price, it would have to be something ridiculously cheap. I would say that literally, I'm not exaggerating, the company's share price would probably have to be, a couple bucks, $2, $3, $4 a share. Maybe I could reevaluate it. But honestly, I think that this company could drop 50% and it would still be pretty overvalued. I know that's a big claim. I know that people might be watching this and say, Jordan, you're crazy. It's dropped 90+%. It's not going to drop anymore. And guess what? I could be wrong about this. It very well could bottom out and go straight up from here. But as of right now, I think that there's no benefit to owning this company. And when you have executives that are biting people's noses off, yeah, that's right. If you didn't hear, we didn't even cover that in this video. You have executives that allegedly bit off a man's nose at a football game, and you have major executives leaving. And then the ones that are replacing them are getting big, fat, stock-based compensation and also are getting major salary raises. This is not the company I want to be a part of. So if you enjoyed this video and you found insight, subscribe if you didn't already, and check out all the stuff down below in the description. Get signed up with M1 Finance so you can get $10 free and help support the channel. Thank you guys so much for watching, and I'll catch you guys next time.